All right. Good morning, everyone. Today is Wednesday, April 10th, and we are back with another Wednesday live show. So, last week, as you probably know, we introduced the brand new trading calculators, and Jeffrey made a video about those, and so we decided that it would be a good idea to put the tutorial video up and give everybody a chance to go over that and watch it and get familiar with calculators. And so we'll talk a little bit more about the calculators today, and we'll go over some different things. We'll take a look at some open trades, a couple of closed trades, talk about the calculators, talk about a little trick that you can use in a market that's acting a little ambivalent. So, hey, good morning, Jeffrey. How you doing today?
Morning, Bill. Everything's going great.
Oh, good, good. Okay, looks like we're live. I mentioned to you that YouTube had changed some stuff around too, so I had to get it all figured out, and I just wanted to make absolutely sure that everything was working good. And it's interesting how they did that right on the same day that we introduced the calculators last week. So when
It
I
was actually a good coincidence that we had the calculators and the new video to put up to watch because, yeah, we would have had some technical issues with the show last week.
Yeah, absolutely. If there's any sort of glitch in the show, I was having some trouble with my internet yesterday. They're doing some work here in the neighborhood, and my internet cut out yesterday suddenly for like 10 minutes. So I used to have that issue when we used live stream, but I haven't really had much problem with it since. But you just never know. So I just want to forewarn everybody we suddenly disappear, that means my internet went out. So hopefully that won't happen. So anyway, boy, we got a lot to talk about today. Jeffrey has brought a little trick that we're going to go over that you can use to help mitigate risk. And I think we should probably start off talking about the overall market and just take a look and see where the overall market stands here. So let me pull up the S&P 500 and zoom out a little bit. You know, it's really kind of interesting recently, I'd say over the past, couple of weeks, week and a half or something, the market has seemed to be acting a little less, a little rougher, right? And even though the S&P doesn't really reflect that, and so it's kind of strange. I mean, we've had a bunch of narrow range days here. Let me take a look at the IWM here. I think the Russell even broke out of this little channel here, but look at how the Russell is sort of struggling just to get back to where it was back up here with all this overhead resistance. And quite honestly, I've always said that the Russell 2000 I think is a bit more representative of the overall market than the S&P is.
Yeah, that's a good, it's good to look at all the markets, but yeah, you're right. It represents more cumulative stocks as an index. So, yeah, market has been showing signs of low momentum, lack of directional conviction, I guess you want to call it. And so, yeah, we've been kind of making moves to the upside and then back to the downside. So, and these are just periods that we're going to, the market goes through. Now, the markets don't look horrible or anything like that. We're not melting down. We're just not going gangbusters right now.
Yeah, it's kind of a lot of narrow ranges, and I sent you a message yesterday that I believe it's out of the last 8 days or something, like 5 out of the last 8 days have been some of the lowest SPY volume of the year, which is kind of interesting. But let me pull up a chart here with the volume. What do you make of like this sort of low volume up here?
Well, again, it's lack of conviction and people sitting on the sidelines. Basically, the market goes through these like low volume periods. Remember, we cycle between high volume, high range, large range, and low volume, low range. And so we're just kind of pushing through that low range period now. Yeah, it's funny you mentioned that because I've been, day trading every day, and you can see how the market just doesn't want to really wake up for a while in the mornings. Instead of blasting off early after the open, we hang around, clang around. This morning was kind of a light open. We got a little bit of movement to the downside now, but not much.
Yeah, it seems to be like a lot of sort of intraday chop in the context of these narrow range days. Look at this. Look at the volume back here in October and November and December when the market was selling off. I mean, just incredible volume. And then as it's had this little sort of V bottom and gone back to the scene of the crime, basically, is where we are here. We're right back to when the market broke down. This is a 50-day moving average, this red line. When the market broke down over here in October, the volume really started to pick up, and we've rallied sort of all the way back there. And I am kind of thinking that the lack of participation and low volume that we're seeing right now is a little bit due to the fact that everybody's in, right? Like there's no like real commitment right now to buy up here at these levels. And so people that wanted to get in are in, and everyone's just kind of waiting to see what happens next.
Yeah, I mean, obviously, when we look at like looking at the SPY right now, you can see just looking at the price bars. And I'm sure if you slapped on a stochastic or an RSI, you'd see we're up in overbought territory. So yeah, money just ends up sitting on the sidelines, or as you said, is mostly already deployed. And so the market could be waiting for a real good pullback, or B, just some consolidation that builds more support, like sideways consolidation, and then that interest will peak up to break it out to new highs. So, the thing about swing trading is that it's not day trading, right? So you don't want to fret too much about what you see intraday because our trades carry through over multi-day periods, 3 to 5 days, 2 to 3 weeks, right? And we go through these little lulls in the market for sometimes a week or two where there's not going to be a lot happening. So you just have to push through. I mentioned in a previous show that when you notice that, the market's not going gangbusters, and maybe if you just watch our closed trades table, you'll see that there's little strings of small stop outs. Take that as a hint that we're just in one of those low ebbs in the market, and take less trades and drop your size a little bit, drop your risk levels a little bit, right?
Hmm.
So we can talk about that when we look at some of the calculators, but this is just something you want to push through, right?
Yeah. Oh yeah. Yeah.
And there's still plenty of winners that are uh, uh, performing nicely, right?
Sure.
It's
Sure.
just that, like I think you mentioned it you mentioned it 2 weeks ago that we go through these periods and it kind of like weeds out the weak stocks out of the mix, right? And then we're left with the good strong ones. So
That's exactly what I was about to mention is that and we've talked about this before, that this back end system is all programmed logic, and so it kind of takes on a life of its own. And one of the things that I've really noticed lately is a lot of with the closed trades, what it's doing is it's actually weeding out the stocks that aren't performing. And so I know that one of your big things is that we want to see a stock move quickly in our favor. That's what you always say. And so this first solar here happens to be, I pulled this up because I noticed there's this big gap up here today. And so if you weed out, there's an old saying, right? It's cut your losers quickly and let your winners run. And so, sort of due to the very nature of the way that the system is programmed, that's what it's doing. It's cutting out a lot of these, like, 2%, 1, 2, 3% sort of losers that aren't getting followed through, and putting those into the open trades, and then, or I'm sorry, the closed trades, and then the open trades are like are running like this. These are stocks moving quickly in our favor. They have upward momentum, and so yeah, it goes back to exactly what you said. It's weeding out the weak stocks, and it's leaving us with a bunch of strong stocks. So
And keep in mind that a lot of these stocks, even though we might get a stop out right on a trade, and remember, you're not taking every one of these trades. I mean, you could, but you're going to be over diversified if you do that. But so, I mean, there's a little bit of luck thrown in there as far as which one trades you do take. Um, you might uh, be able to pick the good ones and miss the bad ones, or you might have some dumb luck and end up with two stinkers while you see a bunch take off. But that's just part of the mix. And again, that evens out over time over the series. So don't fret about that too much either. Just you got to continue through the process, continue through the series. But yeah, this is a good one. Was that FSLR?
hmm
That's a great one where uh, good trades take off very quickly and they don't look back, right? That's one of the flavors of follow through that we get. So this isn't any kind of like rare type of a pattern that you're looking at. This is just one of the flavors that we get. The trade triggers, you're in, and the thing takes off and never looks back, right? So get used to looking for this type of follow through, and then we're going to have the opposite where we don't get follow through. But back to the small stop outs, many of these trades that, let's say, stop us out temporarily, we can see them come right back into the mix, and we get an alert and a setup maybe 2 weeks later for that same stock, and that's when the stock's going to go ahead and make a move like this, right?
sure.
Yeah. So
This is kind of interesting because I hadn't put the target on here. I just looked it up, and you notice that today it's gapping way above the target. Something like this. Would you recommend? And I think I know the answer to this. Would you recommend like today being the day that you pull some off the table on something like this?
well, you could have been there at the open and cut, sold half, right? If you were like right on the, right in the groove there, you could have sold half at the open today on the big gap up. Or if you're coming in kind of late and you're just looking at the chart now, you can go, wow, and slide a stop up on half under today's low, right? Because
hmm
who knows, we might get two more up days right after today.
It happens.
Uh, right. Or let's say you have a super strong close, a long range day up, go ahead and take half of the profits before the close, right? Now, one thing that I recommend, here's another little trick, and this is a real good example of a chart that you can see this pan out, is anytime you get a long range bar, you can also look to protect the midpoint of the bar, right? So maybe give me a little line like right at the midpoint of today's range so far.
Sure, sure, yeah.
And then you can see that is where you could like get a stop in right now, right? If you have to like run to the post office or something, that's where you want to protect, because one of two things is going to happen. It's going to get a meltdown and go right back down towards the open, or you're going to get a strong close up at the high extreme of the bar. So what you're doing is you're protecting that midpoint. Look at how on the other previous long range bars to the left of the chart, you had the big down long range bar under the L, and then you had that green long range bar to the upside. What was it, over on the 6th of March? It looks like maybe put some little lines at the midpoints on those bars. And again, you can see how that's a viable little trick. You get a long range bar, you protect the middle of the range, right? And you see how that worked, right? Followed through, and the same on the other one.
I like that.
Yeah, these are just little aggressive tricks that you can do. The system, the problem with, I mean, I could program the system to do all this stuff, but then it's basically taking a little bit finer control of your discretionary trading, right? So the system does like the real real good basics. We get targets, we get two types of trailing stops, right? You get your trigger line, and then these are little extras that you can do to move your stop around. In fact, we're going to show you, again, we're going to review the little go to break even trick here in a little bit. But anyway, this is exactly how I trade. Long range bars, you protect the midpoint. This works intraday on intraday time frames too if you're day trading.
Yeah, I've got another example I'm going to pull up here for you to take a look at of an open trade that is sort of consistent with what we were just talking about, how we like to see the stocks basically sort of take off in our favor right off the bat. And this one's been kind of interesting because it did exactly that. I mean, there's a couple of days where this EDU triggered and then kind of just waffled around sideways and then just really took off, and you can see how the trailing stop just has been scaling up the whole way, and it was pretty quick to actually hit the target here. Once it hit the target, it started sort of waffling around here. Parabolic stop kicked in, and it sort of looked to me like it was going to come back down. But what I really like about the system is the fact that every time that I think something is going to happen, that doesn't necessarily mean it's going to happen. And so this kind of gives me a nice framework to work within, because when I think the market's going to go down, it goes up, right? And so it kind of keeps you from second guessing everything.
Well, trading over the series works on probabilities, right? And we can take that to, we can logically take that for examples to the extremes. Let's say that you only took one trade, right? That's the super extreme. You only get one trade in your whole life, right? You got to bet everything on a win or a loss, right? That's the super extreme. Well, guess what? Your probabilities there are basically 50-50. You can't really improve on that. But the more you add to the series, the more that the probabilities can come in and give you an edge, right?
Hmm.
So again, trading over the series, you're going to see all kinds of different flavors of follow through, and yeah, you'll see all kinds of crazy stuff. You'll see, um, I think we've had some where, the stock runs up and gaps up in 2 days and hits the target to the near the penny, and that's exactly where it turns around, right? Those kinds of things. Uh, so you're going to see all kinds of follow through over the series, and the crazy thing is, I've been swing trading now for uh, maybe 2 decades, and these same exact patterns that we're looking at are the same kind of patterns I was seeing way back when, right? They just repeat over and over.
Speaking of which, when you mentioned that, it's funny that you mentioned that because I was looking through some of the trades this morning, trying to figure out, which ones would be educational for our show. And speaking of hitting the target to the penny, look at TECK. This has been an interesting one because this thing triggered like way back here in, I guess it was mid-February, well, towards the end of February. It's been open for a long time. But what's interesting about this one is there's a couple of interesting things. One is that after it triggered, it went into a down cycle that came really, really sort of close to the stop. And this initial stop down here stayed in the whole, I mean, stayed in literally until just recently when it started getting raised up, right? Just sort of due to the behavior of this stock. But you'll notice that this thing hit the target. The high this day, which was yesterday, the high yesterday was 25 bucks, which is the target. Look how long that took to actually sort of work out, right? So something like this, patience is sort of the key, right?
Yeah, and this is one of those probabilistic type of things where, I mean, look at the odds of, staying in that. It came so close to the stop and then it like hit the target, by the penny. And so this is just one of those wacky examples of like pushing the extremes on everything, right? And you're going to just get that through the mix. That's one of the things about statistics and probabilities. It's like winning the lottery. They say that you have odds, 7 times greater odds of getting hit by lightning in your life than winning a lottery, right? So you'd
Sure.
go, Wow, that's crazy. But people win the lottery, right? So it's called the law of large numbers. So the more examples that we have go through the series, and you have, that you trades that you implement, trades that you take, the more these types of extreme examples and stuff you're going to see.
Yeah, I'm starting to see a lot. Hey, I wanted to speaking of like the weeding out the weak hands. I wanted to take a look at Boeing here because Boeing's been sort of in the news lately, and when I saw it originally come into the system here back a couple weeks ago, I was a little I was a little skeptical. I'm like, oh man, Boeing's one of those sort of controversial stocks right now. And interestingly enough, this is actually really probably one of the better recent examples of how getting the stop moved up to essentially break even. Now this one got really close to break even, right? And so this is one of the we talk about weeding out sort of the weak stocks or whatever. This is basically what we're talking about, right? Because you got some follow through. I believe that Boeing was up like 8% past the trigger, up here at these highs. But then, of course, whenever there's bad news with the company, especially like this, there's a second shoe that drops. And fortunately, the stop had been moved up here. And so that's going to lead me into, this slide that you sent me, this 3-day trick that we can use. So anyway, great example, right? Great example of how the system will get that stop, sort of the initial stop moved up. And what I thought, there's a couple interesting things about this real quick, and then we'll take a look at your slide. But I noticed that the trigger price here was essentially, just like sort of the upper and lower end of this one big bar here on the 27th. That was the first sort of interesting thing. And I mean, everything actually looked pretty reasonable. I'm thinking if there hadn't been, the bad news or whatever that dropped over the weekend, that this was really about 1 day, maybe 2 days away from the target, which looked pretty reasonable. But
Yeah, this was definitely a news catalyst, stop out. We talk about, the technicals in the market. There's no way to quantify it exactly, but my best guesstimate after all the years of studying and researching and trading the markets is, the technicals account for probably about 70% of price movement normally, right? And then the news comes in and can act as a catalyst and either give a stock a gentle nudge or like a drastic, catastrophic gap against you. And this is example of they had the didn't they get the planes get grounded or something almost?
yeah, that's
Yeah, and
that's
so
basically
that's
what caused this over here. And then some more bad news came out over this past weekend, and that's what
yeah, and here's the thing: the news, the markets and individual stocks can way overreact to the news, right? So what did they have? They had two planes that either had problems or
well, there were
whatnot.
just two plane crashes,
Yeah,
and so
two
the
plane
yeah,
crashes. Um, don't forget, there's been 97 million flights by that same airplane in the past. So statistically, that was just kind of a weird anomaly, right?
sure.
Accidents happen, but this is a good example of how it affects the stock price, right? Now, the good news, I mean, you didn't see any drastic, like catastrophic, majorly catastrophic gap downs, but the system stop got you real close. But this is a good example of, and today's a good day to talk about this again, how you can tweak your trading tactics a little bit if depending on how the markets are behaving or how your performance is doing. And it's called the 3-day trick, right? Basically, what you're doing is anytime you see three higher lows, right? These represent daily price bars above your entry. Uh, you can make a aggressive move to break even, right?
Hmm.
You don't have to. Again, over the big series, the system, even if you take your stops and stuff, they're usually small, so it all pans out at the end, pencils out at the end. But if you want to play a little bit more aggressive and you see three higher lows like this, and I commonly will react to this as well. Get to break even, especially in kind of a duddy market like this where we are seeing more stop outs. If you have a chance to get to break even, take it, right? You can always re-enter a position.
Sure. And I think I think getting to break even is one of those. It's kind of a psychological thing. On the one hand, if you're in a trade and you get to break even and then you just get stopped out at break even, you feel as though you spent a lot of time for nothing. But then again, you haven't lost anything, right? And so you can just move on to the next trade, and quite frankly, like, taking multiple attempts, getting a little more. I think if you were to use this aggressive trick, you'd actually, by virtue, become a little bit more active as far as trading.
Yeah, you're not going to see this happen every single trade you take, but enough of the time to where it can create a little statistical difference for you as far as risk control. So let's say I would say maybe 3 or 4 out of 10 trades that you take, you're going to get this chance, right? And then maybe half of those end up getting stop out, whereas the other half will go on to be winners, let's say. Those are just some numbers I'm throwing out to keep in your head. Again, the actual numbers can kind of change here and there, but over the course of the series. So this is just a good visual trick. And again, it's above where you took your entry, right? And the reason that this makes sense is because think about it. Um, First of all, the markets and stocks tend to go through 3 and 4 day cycles. If you've ever noticed that, right? They'll consolidate down for 3 or 4 days, and then they try to blast off in a certain direction. They run for 3 or 4 days, and that's kind of the average little price cycle, right? And so if you get 3 higher lows above where you took your entry, that's basically saying, okay, look, there's this minimum of like a 3 day cycle. It's above where you took your entry, and if they're going to be able to break those 3 lows, then that the upward cycle might be toast at that point, right? So you're basically betting on that, and this is a great little trick to use. In fact, we've had a bunch of recent examples where you could have easily, you know,
Let me pull one of those up. You had
well,
mentioned.
didn't Boeing, let's go back to the chart on Boeing. Didn't Boeing give us a 3 day?
Yeah, absolutely.
Yeah, so yeah, that's a good example. Now you had the little gap down on that one, but um,
Yeah, well, the system itself actually moved the stop up to, all just not quite break even, but pretty darn close for, a $375 stock. Talking a couple of bucks here, but yeah. And so what you're saying is that you got your trigger here, and then you got your three lows above the trigger up here, and so basically the system stop got trailed up close to break even. And the one that you had mentioned was FATE, right? As an example.
yeah, that's a good example of a recent stop that got hit. Where notice if you had taken the entry right above the trigger line in there somewhere, you had those 3 higher lows, right? So you could have looked at that and said, "Ooh, I'm going to go ahead and just protect my position." And another thing, and this is a good example. You see those 3 days where the lows are higher.
Hmm.
Notice how the third day there, that was an inside day,
Sure.
right? So if anything, that's another little clue. Is like, ooh, the price is gonna blast out to the upside, or it's gonna blast out to the downside. Now we got an inside day. So that was another little clue that, hey, it might be a good idea to get to break even on this one.
Yeah, one thing I noticed about, sort of, kind of hand in hand with the recent weakness in the market, and like I say, the weakness has kind of been masked by the big indexes, but day like yesterday was pretty nasty. I have a big watch list of stocks, and the majority of them were, down. And something to keep in mind like this. I mean, it looks kind of dramatic on the chart, but you're talking about a 2.8% stop out, which is minimal, right? Because basically, we're going back to what we were saying before. The way that the system weeds out stocks like this, in a gangbuster market, this stock would have likely followed through to the upside and broken out up here, right? And
Well,
just sort of kept going.
what is the system giving on the ATR for that one? You
I
know,
don't. No, I don't have that
let me
offhand.
look. I'm going to look and see what it is, because here's the way you want to look at it is, you might have a stock that's got an 8 ATR, the system ATR of 8.5%, right? And so the targets are typically about 3.5 times that. And so if you end up with a 2% stop on something like that, then it's like a mosquito bite, right? That's the way you want to think about it.
Well, yeah. As a matter of fact, I mean, you can look that up, but I'm gonna move on. Don't want to spend too much time on any one thing. Bloomin', right? This is one that I talked about when we did the last live show 2 weeks ago. This is one I actually kind of liked, right? Because I had drawn a, let's see, I drew a trend line sort of across these highs here. This is the way I did it. I was looking at candlesticks. So I drew a trend line across these highs, and I was like, oh man, look at this beautiful pattern here. And interestingly enough, this is another really sort of good example is of moving the stop up to break even. The system, the trigger was 2005. The system literally had moved the stop up to 20. And so this is, I mean, the stats or the minimum shows minus 0.2%. So basically, you lost a nickel because this didn't get the follow through to the upside, and we saw a lot of this yesterday. I mean, a lot of stocks sort of had long range days down just due to the nature of the market kind of running out of steam here. But this is actually a pretty good example of stop getting to break even, no harm, no foul, right?
Right. I mean, the system stop eventually made it to break even, and then you had several, you had two chances there with the three higher lows as well, right? Um, so another thing you can do, you don't want to get too picky about things, but let's say that you get a stock that is on a tear and it really moves in your favor, pretty nicely, and you do get the 3-day 3-day trigger with the three higher lows above your entry. Go ahead and include your commissions in there too. Get your stop, figure out what your commissions are, and get your stop so that when you get stopped out, it pays for your commissions and you don't lose a dime.
Hmm.
You can do that. Obviously, if you've got enough wiggle room, go ahead and do that.
That's an interesting idea. Oh, I didn't.
Yeah, because after one of the things with trading, and again, trading over the series, is after we get good at our setups and our entries and our trade management, the one final thing to master and control are trading commissions, right? At the end, after, let's say you've perfected everything you can perfect, what do you work on? Well, work on reducing the cost of trading. So if you can go ahead and do that, if you've got the wiggle room, you got the 3-day signal to get to break even, and you got enough wiggle room, you can go ahead and just like set your stop to cover the commissions too. Now, commissions are so low these days. Different brokerages have different commissions. Do you realize back in the well, it goes back to like the 70s and maybe early 80s, to do a trade costs like $100. Do you remember that?
Oh yeah,
Yeah.
absolutely.
I mean, I'm trying to remember how we even made any money.
I
You
know.
definitely couldn't be like a high frequency trader in those days.
No, that was crazy. Yeah.
Yeah, and most of the brokerages back then, if I remember correctly, the way they did it is it was based on price. So if you're going to buy 100 shares of a $20 stock, you paid $80, and if you were buying 100 shares of like $150 stocks, you'd be paying like 120 bucks. So they did it that way. It was just crazy.
Oh
I don't know.
yeah, yeah. I mean, well, and back in those days, I mean, people talk about Wall Street being rigged nowadays. Back in those days, you'd have to call your broker on the phone to get a quote, and
Yeah.
then you'd call him on the phone to get a quote, and then, if you told him, well, I'd like to buy some or whatever, he'd probably buy it and front run you right off the bat, and then,
I remember the first big, technological breakthrough when you could trade over a telephone modem, right? You'd actually take the phone off and put it on the modem, and that's how you connect it in.
oh wow.
And the commissions then were like 45 bucks round trip. So yeah, you know, don't bitch and complain about commissions these days because they ain't.
When I
They're,
first started this, man, my very first, I believe it was my first Schwab account or whatever. You would actually trade over one of those touch tone phones. Like you'd call it up,
oh yeah,
and
crazy.
it would say press one to get a quote, and so you'd press one, and you'd have a little way of entering the ticker symbol, and it would give you a quote, and then it would be like press one to buy, press two to sell, and so the very first, and this is back in like the .com days. I mean, so a lot of people that were professional traders, obviously, they had the modem things and all that, but your average trader would use a touch tone phone to get quotes and
Yep.
place orders.
I
So
remember I never took trades like that, but I remember moving some stops around like that way when I was on a business trip. So
imagine how many people all this technology as far as trading has put out of work. Because back in those days it was rooms full of people, and when people were involved in the market and trading or that type of thing, they would call up and talk to a human being who would be sitting in front of a computer doing all that. So
yeah, no,
move.
well, the flip side is it opened up the markets to a greater number of people, lower prices and whatnot. So the exchanges, their modus operandi was to get more, account holders involved, and so, and hey, you can literally set up swing trading accounts now where it's $1 to take a trade. So
Yep.
that's like mind-boggling.
Yeah, so anyway, real quick here, I wanted to look at this VCEL as one that is actually triggering today. Got a pretty nice look to it, so I don't want to jinx it, but I'll draw a little trend line there. So, I had a nice little sort of down cycle, little spike low down here, coming back the other direction. So, it's a fairly decent looking stock, just triggered last night. The other one is we had two stocks that triggered in last night. We're triggering in today. This other one is TNDM. This is kind of interesting because I had this big gap up here and has just sort of pulled back a little bit and looks like it's coming off the pullback. And so, interestingly enough, sort of triggering in this morning right around the spot here, that right around the trigger price, right? So what I wanted to do is just as an example on this, I'm jotting this down on a piece of paper because I'm going to move on to the calculators, right? Because these brand new calculators, and I'm sure everybody's probably had a look at these and played around with them, but um, I'm going to tell you this price differential calculator is the one that I find I use the most. I mean, some of the other ones are great. They're all really good, but this is the one. Okay, so on tandem there, the trigger price was 64.10, the stop 60.30, boom. And so right away I can see what the percentage is for the stop. And I've noticed just sort of playing around that they vary significantly. Right? And so some of these things, I mean, and I guess a lot of it sort of has to do with the average range, but man, this is the handiest calculator that I've ever seen. I'll tell you another thing that I do here is like you could just say something like, "Hey, remember when the S&P bottomed at 666 and now the S&P is at 2881, right? Geez, how much is it up?" Oh, what did I enter something wrong? There we go. I didn't put a decimal. Huh, that's weird. Price 1, price 2. I had this working the other day. Oh, well, let me hit F5 here.
Take
Wonder.
the decimal out real quick.
All right, let me try that again. Maybe it doesn't like that number. Let me put in 667.
Let's see.
2881. Yeah, because I mean, I just I just did this the other day, and it was, I mean, it was telling me, that it was up, so I can't explain that, but
Huh.
yeah, so
Hit a refresh. I'll have to look at that.
1850. Let me just put in some random numbers. Yeah, for some reason it's act. Oh, you know what it is? I'll tell you exactly what it is. Is in order to use these free stock charts, right? I'll tell you what it is. In order to use these free stock charts, I'm in Microsoft Internet Explorer, which is basically a depreciated browser, right? Totally depreciated browser, and it just doesn't like stuff, right? Like stuff does not work in Internet Explorer, and this is an old version. This is like Internet Explorer 9 or 10 or something, and so it just does not. Well, I'm going to try this on my other computer, exactly what I just did there in my Firefox browser, which is all up to date, and I guarantee it'll work. So yeah, this browser is not going to cooperate. Yeah, so I just did it over here. Here, I pull this
Well, I'm glad you found it was the
here.
browser and not my coding, so that I had to get in there and figure out what the heck was going on.
Yeah, no, it's here. I'll pull this over here so you can see it. Right. As a matter of fact, let me whoops. Let me scroll down this page a little bit. There you go. So yeah, I just learned something. Well, here's the thing: I mean nobody, is using an old Microsoft Internet Explorer. The only reason that I still use it is I have to in order to run the free stock charts because it's running Silverlight, which is also like another. No other browser supports Silverlight, but anyway, so long story short, here we are in my Firefox browser. Everything's working. I had never played around with the calculators in that old browser. So this is the most useful calculator of all. I mean, say
Yeah, I do those same kind of, well, what if scenarios and all the time, right? Yeah, you can look at the market, where it is, where it could be going, and you can figure out the percent differences. You can figure out if you're going to take a trade, you can kind of guesstimate where you think the stock might go to, and do like a what if scenario and see what kind of percentage gain that would be, how much money you'd make, that type of thing. So yeah, these are, again, I think I described it in the video. These are all calculators that I just started. I originally made all these for myself in a spreadsheet,
hmm
a decade ago, and I just use these constantly in my swing trading. So these are just handy dandy, super duper little calculators to utilize.
sure. And what I was about to say about the price differential calculator, what I find that I use it the most for is these really odd numbers, right? Like say you buy a stock for, 21.38 and now the stock's at 22.69, right? In just a couple of seconds here you can see exactly what the price difference is and so how much you're up or down or whatever. And so this is probably the handiest one. The one that's probably, the most I wouldn't say the most useful, but this is all about the risk management, right? The trade dollar size calculator. So this is the one that say you got a $15,000 account and everybody knows that you're supposed to basically, figure out sort of a fixed amount that you would risk out of your total portfolio, like the old turtle traders thing. So, I believe, and I've been doing a little reading on them, but they had this thing where they never risked more than 2% of their account on any one trade. And so if you had a $15,000 account and you were never going to risk more than 2% on it, then, boom, there you go. And so, but see, here's the thing is most people's accounts are like, 15 to 38. 50, right? And so that's where this like really sort of comes in handy. What did I? Okay.
Yeah, and the other thing is that you can round it down, right? If you had
Gotcha.
15,000, $210, you put 15K in there if you want. The idea is to get a basic idea of your risk. I go over this in the video pretty detailed. I wouldn't recommend you start off at 2%, right? Uh, and as you go, you could actually risk more than 2%. Again, it's all relative based on your performance. So I think in my example, there's nothing wrong with starting off the lowest level, 0.1, right? You're not going to lose sleep. You're not going to get nervous. You're going to be able to go through the motions. The best approach that a person can take is the go slow approach. Before the 50, this is just a little segue. I used to give this example in the past. Before the 50s, when the commercial airliners were uh, starting to grow and people were starting to travel more by plane, they didn't have any rules about really how airplanes landed. The airplanes would get over the airport and just kind of dive bomb down to the runway, right? And they were experiencing lots of accidents and congestion problems. And so in the 50s, they did this big old study, and they determined that the best way for a commercial airliner to come in is the long, slow glide approach, right? So you notice when you're on a commercial airline flight how, yeah, what is it, like 30 minutes, 40 minutes before landing, I guess, depending on how long the flight is. Um, they'll come on and say, yeah, prepare for, we'll be landing, in 30 minutes,
Descent.
and right, and you notice that the plane starts to gradually descend from one plateau to another. So they determined that was the best way for airlines. So I use that exact example. The best way to become a consistent, profitable trader is the long, go slow approach. So what that means is you pick a incredibly small starting point, like your example there is a good one, and figure out a risk level, right? And it'll be like a really small risk level. But the point is you just have to keep trading at that level. Uh, when your performance warrants, and I think I mentioned in the video, you go, I would do it in 2-month segments. So trade for 2 months, evaluate if you've got positive performance, bump up your risk level, right? Stay it there for 2 months. So the goal is by the end of the first year, you could be up towards like your 2% risk, and it's not going to phase you a bit because it's all relative. You should, to get there, you will have to be riding on lots of house money, right?
Hmm.
So anyway, that's the concept behind that. And then
Yeah,
that's the number you'd plug into the calculator up at the top.
well, that's exactly what I was about to say. And so up at the top, so in this example, we're risking 76 bucks per trade, and so this calculator up here, you get a you get an entry like we had the one at 64.10, right? And the stop loss was 60.30. This is why I wrote this down. And there you go. Tells you how many shares to buy. Talk to me about buying 20 shares. Most people don't think that, geez, why would I want to buy 20 shares, right?
Well, because in this process, you want to get away from thinking individual trades. What we're really doing is we're trying to introduce money into the markets and rotate money into the markets in the safest way possible, which is to diversify a little bit, right? Because the one thing that can get us in swing trading is a catastrophic gap down on our position. So if you're all in with everything on one stock, that's where you run the biggest risk, right? Because you know the thing about swing trading is we make our money by holding several days, right? But in order to hold several days, we have to hold over the close, and that's where those nasty gap downs can hit, right? So the only way around that is to diversify a little bit, keep your sizes low, and in the beginning, get away from even worrying about how much money you're making. You want to focus on what are the percent gains on the trades that you're capturing with money deployed, right? So if you do this is all mechanical, folks. It's just a matter of sticking with it, right? Even on these downturns in the market where it doesn't seem like there's a lot of trades following through all that great, you got to just stick with it. And guess what? Before you know it, like next week, the market can just wake up and take off like gangbusters. And if you're on the sidelines, you miss those profit opportunities,
You
right?
know, there's an old saying on Wall Street that diversification is the only free lunch, or something similar to that. But yeah, absolutely. You know, I've been reading some interesting stuff. There's you've heard of this W.D. Gann guy, right? Have you ever heard of him? I mean, he
Oh,
invented all
I've
sorts. He's like one of the most famous traders ever. And I ran across this book that he wrote in, I believe it was like 1947. And there's three little specific sections of advice that he gave in that book that when I read those, it blew me away because I had seen one of them, right? And I saw one somewhere and I couldn't remember who wrote it. And I was thinking it was that other guy, you know, reminiscence of a stock operator guy. And so anyway, I searched for it and found out it's this W.D. Gann in a book that he wrote called something like 45 Years in Wall Street. But anyway, long story short, he had 3 points that when I read them, I couldn't believe it because they were totally consistent with what we're doing, you know, kind of how this automated service is built. One is that you always have to use a stop loss, and that he advised, always using the stop loss and moving the stop loss, like moving the stop loss as the price goes up. The other one that he recommended was that you always want to diversify, meaning that you don't want to be in four stocks in the energy sector, right? So when you're going through the list of stocks that are triggering, you kind of want to have an idea that hey, maybe I'll sort of spread this out across a few different sectors. And the last one was, and I'm trying to remember this, it's on the tip of my tongue, but the last one was that you should basically, that you should basically always, oh, I know what it was. It's like look to get your stop to break even, right? I believe that was it. But
all right.
I'm gonna, I saved these little blurbs and I'm gonna turn those into a blog post because it's fascinating that a lot of these old school rules, from Wall Street, like back in the day, that are written in these books. And the same thing with the turtle traders. I found a PDF of like the original turtle strategy because these calculators got me interested in like position sizing. And I always remember that the turtle method was all about only risking a small portion of your overall portfolio. So
If I remember correctly, I remember reading a couple books about the turtle traders. If I remember correctly, they basically had one kind of a setup that they were allowed to take. They had to wait for the stock to drop a certain amount, and then they would buy. I think it was. You can correct me if I'm wrong. Buy over a 20-day high or something, or a
it was a
22-day,
55 day high. They
55-day high,
Yeah.
and then they just had to follow strict money management rules,
Hmm.
right? And if I remember correctly, if you didn't follow the rule, if you broke the rules once, you got kicked off the
Yeah.
thing, right? So, um, and the point is at the end, the ones that just adhered to the strategy all made money.
Yep, absolutely. Yeah, it's fascinating, and so I'll maybe send you that PDF that I have so you can check it out. It was actually written by one of the original turtles. So that's all fascinating stuff. But it's just things that I stumbled across that ended up being consistent exactly with the strategy that we're using here. So
Let me give everybody like two concepts to take away also today, as long as we're talking about these calculators. Um, you know, especially if you're new to kind of getting involved with this mechanical system, um, or new to swing trading altogether, either one or both, then a good way to think about this is this. Uh, it's good to simulate or sim trade or paper trade any system before you you know employ it, right? However, the problem with paper trading, where you don't even actually take a trade, you just like say, okay, I would have taken this trade, I'll write it down. It's so boring that nobody ever can follow it, right?
sure.
It's just you don't have any skin in the game.
Hmm.
So a great thing to do is to just say, hey, for 2 months, I'm going to paper trade, but I'm going to do it live, but I'm going to do it at such a low level it's almost equal to paper trading. And that's where you'd go in on your account calculator there and put in like 0.1. It's going to give you an incredibly small number. Now, obviously, if you've got like 5K and you put that amount in there, your risk level would be so low. But the point being is, again, don't even worry about the money you're making, but just go through the actual mechanics of taking the trades and using the calculators at that really low level. You won't fret, you won't lose sleep, you won't get nervous, you won't wipe your account out, and just go for the first 2 months, and that is your live, you know, beta test of the system. And that should give you enough trades in the series over 2 months to where you should have an edge that will convince you that, hey, I got something here. And then, month 3, you bump your risk levels up. So that's one thing, a way to approach this. And again, it's very mechanical. Every 2 months, put a thing on your calculator or on your calendar that's set to remind you, I'm going to evaluate my performance. And if it's positive, and we can do a show about how to analyze stuff,
Hmm.
you bump up your risk level. Now, the other little concept I wanted to get across is this. Uh, we are taking individual trades, and we do have to like move the individual stops and go for the individual targets. But again, think of that what you're trying to do over time is just deploy more and more of your capital into the markets, right? At the same time, rotate, kind of rotating it around. But because of the nature and the known dangers of holding overnight, we got to diversify, right? So it breaks it down into lots of trades. So if you run into a week where you hit a bunch of stop outs, get away from thinking like, wow, I had 3 stop outs or 4 stop, whatever, and think about it as, you know, quantify your results for the week. In other words, you had 1 week, it was a stop out week. So in other words, get away from mentally thinking, oh, like 3 trades, and no, that was just a stop out week,
Hmm.
right? Because then you're going to have weeks where you have 3 or 4 big gangbuster winners, right? And so that was a big gain week. So if you start thinking mentally like that, it's not a big deal. So what would be interesting to do, and we could do this, you can do this, you could take your net gain or loss for the whole week and plot that out on a graph, right, as like a single trade. You follow me?
Sure.
And just look at it kind of that way.
Yeah, that's interesting. I mean, you always talk about the winning over the series, and so, this particular strategy of sort of cutting the losers short, letting the winners run, and the idea that we want to get in and have them run quickly in our favor, as you say. It's a really good methodology, and what I'm finding out is that it's very consistent with a lot of the old rules, the tried and tested and rules of Wall Street that have worked, forever. It's basically having a strategy like this.
Yeah, and again, another thing you can keep in your mind, because remember, a lot of trading is kind of psychological. You want to stay kind of positive, you want to stick to a plan, and the more mechanical you can make it, the less you fret about it, right?
Hmm.
Because here's the reality, 6 months from now, if you can stick with the plan, you're still going to be taking trades, right? And in 6 months from now, you could be like have a nice profit under your belt as long as you just stuck with the series, right? So it's going to happen. Like 6 months, you'll be here a year, hopefully, 3 months. So the point is just think ahead that everything works over the series, works mechanically, and you want to keep it easy on your nerves and just like ratchet things up as you go. The final thing I was going to say though was, and now I thought I lost my train of thought because I rambled on.
Yeah.
Um,
Well,
anyway,
what I was going to say is, yeah, sticking to the strategy over time because the market is going to go through its different cycles, right? And so the weak cycles are going to, hopefully result in a bunch of small stop outs, which is fine. And I go through the I look at like these 2% stop outs, 3% stop outs is just like sort of weeding out the weak hands, and then you go to the open trades and you see like that we still have a lot of really nice, winners that are still open and they can go up. And so inevitably, and here's what I was going to mention is we're just about a week away from the big earnings season, right? And so you remember last earnings season, sort of by virtue of the fact that we closed these trades ahead of earnings, a lot of these gainers actually a lot of the gainers will get locked in at earnings season because we're not going to hold them overnight when they release earnings. So that's going to be kind of interesting.
Yeah, the final.
You got a final point you're going to make. Hopefully, I didn't lose my feed here.
No, the final thing I was going to mention is that uh, in your mind, you're going to experience three outcomes, right? You're going to experience full stop outs. Those are the nasty ones where you get in and maybe like within 2 days it just drops and hit, like a lead balloon. It just drops down and hits the dang stop. Those happen, right? Just those are the stinkers, and just take the stops and uh, go back to cash on those and get ready to redeploy. Then you're going to get um, lots of good follow through positions, right? That just naturally, like the one we took a look at, that FSLR, I think, it just took off on its own, right? You just bought it and it just blasted off, right?
Hmm.
So you're going to get lots of those. And then the third one in the mix is the break even. So either the system stop will get you to break even, or you can use the little 2 bar trick. I'm sorry, the little 3 bar low trick, where you have the 3 higher lows above your entry. Between those two, so your trading ratio should break down between those three: full stop outs, break even stop outs, or the gains. So when you pencil this all out over the series, what you're gonna find is you will end up with more winners than full stop outs and than full stop outs, because the break evens get in the middle there and they prevent the full stop out. You get that?
Hmm.
So the break even move helps reduce the ratio of the full stop outs. So again, just keep that in mind, that's one of the third scenarios, and that has an effect on the overall odds of the trading. So yeah, if you see the 3 higher lows and we're in kind of a crappy market, get that stop to break even.
Interesting, interesting. All right, well, we've covered a lot of material here. The show should be live up on the page for the rest of the week. Like I say, YouTube's changed a few things around, so I'm still getting used to it. But anyway, hey, this is a really interesting show. We covered a lot of material, and we will get a replay posted. And if you missed it, so I want to thank you for coming on today, Jeffrey. Really appreciate it.
No
And I
problem.
will talk to you. We'll do another show, and we will talk next week.
Very good. See you, Bill.
All right, see you later.